We'll have a quick look at what is a pending tax raid in the UK. The UK's got into the habit of having two budgets a year. Very tame in April 26, but November is now setting itself up for some significant tax changes going into the 27-28 tax year. We're a third of the way through the UK tax year, the current situation. We've got the pension uh, uh, inheritance tax levy we know that's coming in, but the burden of tax is set potentially to rise even further in the UK with a new Prime Minister without a new electoral vote to bring in any potential changes. The OECD reported in the last week that the UK should consider, in this period of turmoil and change that they've got, actually changing their tax creep that they've got going on. There've been 25 billion extra taxes imposed in the first 2 years of the current British government, both on employment, on capital gains tax, inheritance tax and pensions. So for business in the UK, for property owners in the UK, and for income taxpayers in the UK, it's not going to get any better in the next few years. So Britain's record tax burden is kind of here to stay. So what can you do about it? At ProAct, we can help you manage that as best you can, but living and working abroad is an answer. If you work remotely from the UK, you can still be employed by a UK company or your contractor, but you could be a tax resident in another country, which means your income tax burden can fall. You can't stop your eligibility to capital gains or fixed taxes in the UK, but if you take your employment or your self-employment from the UK and carry out that as a resident in another country, you can pay lower income taxes there. The national insurance is not necessarily the same as an income tax or corporation tax liability. So there's different states which can be. So whether you're a company, an individual, a contractor, an employee, a trust fund or a pension fund, there are different rates of taxes that can apply. But what we know is what's set in stone in the UK, and that's only really going to increase going forward. There's no immediate prospect of any radical reduction in that. What you've got in the UK is a stealth tax of frozen allowances. It's already confirmed that personal allowances are not going to change through to 2030. That's 10 years of frozen personal allowances. Meanwhile, wages rise, inflation rises, prices rise. You end up paying, people are moved up to a higher tax bracket by just standing still because the personal allowances aren't there. So whereas in England, you've got £12,500 personal allowance, you can have a personal allowance in Cyprus of 20,000 before you're paying any income tax. So there are ways and means around these things if you want to consider that. There's also the fear that potentially the frozen inheritance tax band is going to be disbanded a bit more. Although inheritance tax is frozen at 325,000, if you've got a residential property in the UK, a married couple can get an extra £175,000 relief each, normally giving a married couple £1 million to hand over to the next of kin. Very, very, very easy. My speculation, but very, very easy choice for a new Chancellor to make big changes would be to simplify inheritance tax in the UK by removing the special relief that only applies to people with expensive properties, the 175, and then increase the inheritance tax band for everybody. Even if they increase the inheritance tax band for everybody from 325 to 350, it would still mean they would have a net increase. They bring more people into their inheritance tax net of 40%. Don't forget, you've already got your pension plan going into your inheritance tax pot next year. 325,000. Everything else above that is 40%. What about capital gains? Now there's an issue. There's an issue, isn't it? Rachel has already put up capital gains from 10 to 18% of the basic rate and up to 24% at a higher rate. So if you wanted to simplify the tax bands, the new Chancellor, the new government by the elected Socialist Labour Party could easily, very, very easily introduce, let's simplify the capital gains tax rate, make the capital gains the same as income tax, 20 and 40%. That means that capital gains would then have effect doubled under the current government from 10 to 20%, whereas the higher rate would then go up to 40% from 24. So capital gains could rise, inheritance tax allowances fall, and so everybody's paying 20 or 40% in the UK. So UK with the highest capital gains and property taxes in the world is going to only get worse for people living and working in the UK. You can work remotely for a UK company. Now, whether you own the company or you're an employee or a contractor, if you can work from home, you can work around the corner, you can work in another country, and that country can potentially allow you to pay lower taxes. So in Cyprus, for example, a British person can't necessarily work in the EU with the EU restrictions, but they can live and reside and work remotely for a UK company, whether it's their business, as an employee, as a contractor, work remotely, pay their taxes in Cyprus, where the maximum income tax rate is 35%, but for expats, you get a 20 to 50% discount. So you could be on a salary of €55,000, £50,000, and only paying 17.5% income tax. National insurance is something different. So if you're working, you still pay your national insurance in the UK, but that then gives you still healthcare in Cyprus or the UK, depending on where you're living. So if you've got a business, or if you're an individual that's an employee or contractor, and that you can work remotely and you wanted to remove yourself from the pain of higher capital gains taxes, income taxes, pension taxes, you can consider with your employers or organising your business to base yourself to be living and working abroad in Cyprus. One of the sides to this as well, don't forget, if you've got a pension fund, the worst case scenario is that the pension is a fixed asset in the UK at the moment. Very, very fixed, okay? But if you are tax resident in another country, you can draw down pensions in other jurisdictions. In Cyprus, that pension drawdown income is 5%. Now, when they're talking about increasing the state retirement age, they're not talking about increasing the minimum retirement age, which is 55. From the age of 55 upwards, if you're living abroad, you can draw from your pension fund at 5%. Now, if you draw all your pension fund at 5% tax, you've then got it out of that inherited tax bracket immediately. You can reinvest it outside a pension fund and potentially get more consistent long-term returns in that respect as well. So living and working abroad, working remotely can save you a lot of time and a lot of income tax expense, and still allow you the freedom and flexibility to move around. A UK employee, a UK citizen, has to satisfy the criteria to be non-resident in the UK. But if you're anywhere else around the world, you can pay income tax there, which could be anywhere from 0 to 17.5%, maybe 35%, but not the same high penal tied-in tax rates you get in the UK. For more information and guidance, contact us at propartnership.com.
To enjoying life abroad. and letting ProAct handle the details.